Well, good afternoon, everyone. Welcome and thank you for participating. On behalf of SCORE, we have two chapters that are co-hosting this afternoon's event. Those from Indianapolis, Indiana and Columbus, Ohio. We're welcoming Jason Crace, a certified public accountant, to present to you some hints about preparing your small businesses for income tax. The SCORE organization, if you're unfamiliar, is an entirely volunteer organization that is considered a resource partner for the Small Business Administration. We provide all of tools and mentoring services all for free. So if you go to the websites that are prepared by either the Indianapolis or Columbus chapters, you'll see a wealth of opportunities to sign up for free mentorship or to pick up some tools such as some checklists, some questions you might want to ask yourself, and even some Excel or Excel files to organize some of your data. So with that said, Jason, why don't you take it away?
All right, Mike, thanks so much. I appreciate the opportunity to speak with everyone today. I know we've got, I believe, an hour scheduled for today, Mike. A lot of information we're going to try to get through. I do have the chat window open. So whenever I do a presentation, I always encourage everyone to type in those questions. I'll try to get to them as quick as I can, make sure I give as thorough an answer as I can. Now, in today's presentation, we're going to cover a couple of things. We're going to talk about business organization, talk about income and expense recognition. We'll address the topic of depreciation and how that affects you tax-wise. Plus, then we'll go through some business tax strategies and some individual tax planning strategies at the end. Now, for business organization, we're referring to how you've legally set up your company with your state. Now, there are three main concerns that we address when it comes to taxes when we're talking about your entity type. We worry about your legal liability, the tax implications of that particular entity type, and then what are the formation administrative expenses to form that entity. If you're a sole proprietor, you are assuming full legal liability of anything that may or may not occur in your business. This could expose some of your personal assets if something should happen in your business. Also, the income and self-employment taxes are both going to apply to any kind of income you earn as a sole proprietor. Now, the good side of being a sole proprietor is it's very easy formation. There's low administrative expenses. Normally, there's no registration necessary in the state, except for possibly some sales tax, withholding tax if you have employees, or you may want to register a DBA in order to protect the name you want to operate under. Now, a limited liability company has become very popular over the last 15 to 20 years. These types of entities are going to limit your personal liability. However, you're still going to be subject to income and self-employment taxes from the income from this entity, but it's easy formation and it is low cost. Most states only charge approximately $100 to $200 to form an LLC, to go ahead and register it with the state agency. Normally that's the Secretary of State's office. Now, a corporation is a little bit different. A corporation is going to make you individually exempt from any personal liability that could occur inside the corporation. However, the corporation is a standalone entity within your state. It has entity level or pass-through taxation. That means that your corporation is either going to pay taxes or you can file some elections, and that taxation is going to flow through to you as the owner. The downside to having a corporation is there could be some extensive record keeping and tax preparation expenses you're going to have to deal with. A partnership is a little bit different from a corporation, an LLC, and a sole proprietorship. In a partnership, generally the partners are going to share the liability that could occur while they operate their business. They're going to share profits and losses, however they've agreed upon to do that. And that's normally drawn up in some sort of partnership agreement, or even in, you can draft an operating agreement. Now, your record keeping and tax preparation expenses are going to be a little bit more expensive than a sole proprietor or a small LLC. You're going to have to register with the state. You're going to have to keep some partnership minutes. And the partnership tax return is one of the most difficult that's done out there. And I always recommend you hire a professional to prepare that. Now we're going to get into the biggest part of the chapter for today. Income and expense recognition. This is usually where the biggest questions are going to come from. When you start a business, there are two different types of method of accounting that you can use to report your income and expenses. There's cash and then there is accrual. Now, the cash method of accounting is much simpler. You record the income when you've received it. You're not going to record into income any of the accounts receivables that you may have at year end. And you're going to record your expenses when you pay them. Now, that means if you had any unpaid bills at the end of the year, you're not going to get to deduct those expenses. There's going to be no payables. You are literally doing on a cash in and cash out type of accounting. It's simpler, it's easier to track, and it can simplify your tax reporting. Now, the accrual method of accounting is a little bit different. Under the IRS rules, you actually record your income when it's earned if you elect to use the accrual method of accounting. That means you're going to have to track accounts receivable. Once you send out those invoices to your customers, once you've completed the job, and in your mind you have earned that income, you're going to put it in your income and it's going to get recorded on that tax return, regardless of whether the customer has paid you when it comes to filing time. You're going to record expenses when you incur them, not when you pay them. So if your vendor sends you an invoice before year end and you still haven't paid it, you're going to record that into your accounts payable and you're going to get that deduction because you have obligated yourself to pay that vendor for that service. You're going to owe that money. So that's the accrual method of accounting. Now, in general, if you look at the US code, and I recommend don't go and look at tax code unless you really got unless you've got a hard time falling asleep, because it can get very mundane. But under the code, in general, there shall be allowed as a deduction all of the ordinary and necessary expenses paid or incurred during the taxable year in carrying on any trade or business. I've highlighted and blued ordinary and necessary because a lot of clients that get in trouble with the Internal Revenue Service or when it comes to reporting their income taxes fail to meet that definition right there. The expense isn't ordinary, nor was it necessary. So let's go through kind of a laundry list of some of the business deductions that are available to taxpayers out there in business. Advertising, marketing, fairly straightforward. If you pay for any advertising, spots on the radio ads, sponsorships in Little League organizations, flyers, mailers, brochures and postcards, all those are deductible under advertising and marketing. Commissions and fees. Any fees you have to pay to maintain a bank account, if you pay commissions to salespeople, those are deductible. Communications tends to be a catch-all for a lot of things. I like to think that communications is telephone, cell phone, fax, internet costs. As long as you're using those to administer your business, they are allowable and they're necessary and ordinary as a business expense, and they should be deducted from your taxes. Contract labor. Now, contract labor is when you've hired someone to provide a service to you or do something for you in your trade or business, and they've agreed to do that. They've done the job and you've paid them. Contract labor is also deductible. Insurance. Now, there are multiple different types of insurance and they get different treatments. When we're talking about generic insurance, we're talking about possibly liability insurance. E&O insurance is one. Errors and omissions. General liability insurance that's going to protect you from lawsuits or from torts or anything of that nature. So insurance is also a deductible expense as long as it pertains to some protection for your business. Interest paid. Interest obviously is the cost of borrowing money. So if you use credit cards in your business and you don't pay those credit cards off every month, then you're going to run into a situation where they're going to charge you some interest. Well, if those purchases were made in your business, then the interest on those credit cards is also deductible. A lot of clients forget about the use of credit cards when it comes to tracking their business expenses. The IRS came out about 15 or 20 years ago and clarified, if you use a credit card in business, you get to take those expenses when you charge them on the card, not when you pay the card off. What the IRS said is basically credit cards act just like business loans. So if you went and you took a loan out to buy equipment, then you get the deduction for the equipment in the year that you took the loan and purchased it. You don't have to wait until you pay back the loan to get that deduction. Same thing for credit cards. So if you have any interest on business loans or interest on business use credit cards, that's going to be deductible as well. Professional services, you pay for the assistance of an attorney to maybe help you with contracts, to help you with legal issues, to draw up contracts, to maybe help you form your LLC or your corporation. Those are deductible. Your accountant, you pay an accountant to prepare your business tax returns, maybe a bookkeeper to help you on your books. Those are deductible professional services. As long as the service being provided is for or centered around your trade or business, it's deductible. Now, rent or lease can be a little bit differently. We're talking about equipment and space. So if you rent space like a store, warehouse, office, absolutely deductible because that's where you're conducting your business. But it's also possible to deduct rent or lease for equipment. You may lease a copier, you may lease a computer, you may lease some sort of heavy equipment. Those lease payments are deductible as an expense. Repairs and maintenance is a common one. You have a piece of equipment that breaks down, computer that needs to be worked on by your IT guy. Anytime you're repairing or maintaining the equipment or the supplies that you're using in your business, the cost of repairing and maintaining those things is going to be deductible as well. Supplies is a pretty big catch-all for those. Supplies could be tools, if you're a tool and die shop, or a handyman or a contractor, some of the tools that you're buying. You may be buying some materials such as wood, screws, nails for those different types of things. We're also talking about general office supplies, paper, toner, ink, staples, pens, all those different types of supplies. As long as you're purchasing those with the intent of and using them in your business, then you have a business expense and it should be deductible. Taxes and licenses. One of the things I want to point out in taxes is that your income taxes, the taxes you pay on the net income of your business, is not a deductible business expense. That is an income tax that's levied on the individual, similar to the taxes that you pay on your W-2 job. You're not going to be able to deduct those taxes. When we talk about taxes, we're referring to things like personal property taxes on business equipment, the auto fees that you may pay for a business-owned car, taxes such as payroll taxes on your employees if you hire employees. And then licenses can be a lot of different things. For instance, your professional license. As a CPA, I have a license that's administered by the state of Indiana, the Indiana Professional Licensing Agency. When I renew that license, there's a cost. So that cost is also deductible. Now, travel and lodging is a pretty local. Hold on, got a question. Let's hop back real quick. Donations to local fundraisers deductible. Yes. Now, there are some nuances when it comes to making donations to local fundraisers. If you are truly making a donation, for example, an organization like Goodwill or Salvation Army or the ALS organization comes to you and says, we'd like you to make a donation. If you write that check out of your business account, you hand it over to the organization, and it's truly a gift, truly a donation, meaning you're not getting anything in return, then it's a donation. It's not deducted as a business expense. It has to be treated as a charitable contribution. And there's a whole different section of rules for charitable contributions. Just like you as an individual taxpayer who may write checks to your church. Those are deductible, but they're deductible on your Schedule A as an itemized deduction as an individual taxpayer. Same thing's going to happen if you write a check out of your business account. If it was a donation to an organization, a true gift, nothing in return, it's going to be a charitable donation. Now, if you're making a donation to the local Little League, the local football league, some sports league, another local organization, and they've in turn agreed to put your logo or your business name on their jerseys, on shirts, a sign on their property, now I think it's not considered a donation. That is, like the question pointed out, that's a marketing opportunity. Now it becomes a sponsorship, and that's different than a donation because you're actually getting something in return. You're getting some advertising, you're getting some exposure. Now that is a business expense, and it doesn't have to be treated separately as a charitable contribution. So I hope that clarified that. Next expense account we were going to talk about was travel and lodging. Travel and lodging is big and pretty general. Anytime you travel with your business, and now the IRS code is very clear. It says that the primary purpose of your trip is to conduct business. The primary reason is to conduct business. Then the costs of travel and lodging, such as airfare, deductible miles, all those different types of things are deductible as a business expense. A lot of times I get the question, well, I'm a travel agent, I'm going to Florida. While I'm in Florida, I may go and talk to some other travel agents or go visit some other resorts. In that case, the travel would not be deductible as a business expense because the primary focus on that is pleasure. That's a vacation. Now, you may have some deductible expenses that may be incurred while you're on vacation. For instance, if you went and took out a potential client or talked to another travel agent and had a meeting, you could have some expenses there. But the overall cost of the trip would not be deductible unless the primary focus is business. Utilities, electric, water, sewer, trash, those things that might surround the operation of an office or a storefront are deductible when they're tied in to that location. Now, there are some special rules when it comes to health insurance. So I wanted to point those out. When your health insurance falls under a different section of the code, and health insurance is deductible against your ordinary income if you have a net profit from self-employment. So if you're a sole proprietor, you fill out a Schedule C, you have net income on that Schedule C. If you paid for your health insurance out of pocket, you can deduct that health insurance against your income taxes. If you're a partner in an LLC or a partnership and you have health insurance, then it can also be deductible against your ordinary income. Or if you're a shareholder of an S corporation and you pay out of pocket for your health insurance costs. One thing to remember is health insurance isn't deductible as a business expense. It has special rules, it has special treatment. So it doesn't lower your business income taxes, but it can lower your income taxes as an individual. And it has to get special treatment. So if you have out-of-pocket health insurance, make sure to break that out separately so your tax professional knows that. Or if you're working on your own taxes and you're using a program like TurboTax or H&R Block Online, make sure you segregate that out because it's going to get special treatment on that tax return, and you want to make sure you capture that so it reduces your income taxes. One of the biggest questions I get from clients is, well, what about auto expenses? Should I buy a car and deduct it? Should I, do I take miles? How do I do this? Well, automobile mileage, by and large, is going to be a bigger deduction than trying to deduct the actual costs of the automobile. I've been doing this for 20 some years. I'm not going to age myself and give you the exact number, but I can tell you that about 97% of the time, it works out better to go ahead and deduct the actual mileage rates. Now, I didn't have time to go in and update the rates for this year, but for 2021, the rate is 56 cents per mile. So, for example, if you drove 10,000 miles during the year, you multiply that by 56 cents a mile, you're going to get a $5,600 expense against your business income for the use of your automobile in that business, in that trade or business. Now, you're going to have to keep a log of those miles driven. It doesn't have to have beginning odometer readings and ending odometer readings every single day, but it should have the total miles you've driven, the location you went to, and what the primary business purpose was. So one of the things I tell clients is, if you want to go get one of those apps, then Mile IQ is a big one. You know, that's the one where it will actually track you as you drive around on your smartphone. You can swipe left and you can swipe right to tell whether it was a personal trip or a business trip. Those are great at tracking the miles. You can export it at the end of the year, and then you can add the comments in about telling what the business purpose was and possibly what the locations are. Now, if you're working remotely, there are some special rules. A lot of those depend on whether or not the location you're working at is temporary or permanent. The IRS has defined a temporary work location as one you may go to for less than 12 months at a time. So if you have taken a specific job and you're driving to a specific location for less than a year in order to complete the work done, then that, I believe, the mileage would be deductible. May need to know some more details, but if it is a temporary work location and not a permanent one, then it should be deductible. If you have an office or a storefront, driving to and from the office from your house is not deductible. That's considered commuting, and those miles are never deductible. Well, I can tell you, Michael, the reason that the rates have gone down is because the government is always in looking backwards. So when they established the rate for 56 cents a mile, it was based on what the gas prices were in 2020. So they were lower in 20, because what happens is they have to tell taxpayers at the beginning of the tax year what the rate's going to be. So at the end of 2020, they announced, and it's usually under revenue procedure number 1, they announced that the standard mileage rate was going to be 56 cents a mile for 2021. So they had to make that decision based on 2020 data. Now, I haven't had time yet this tax season to look and see what the rate is for 2022, but it should have already been released. So you can probably do a quick Google search and put 2022 standard mileage deduction, and you'll be able to pull it up. And it should have gone up from 56 to possibly 57 or even 58 cents a mile because gas prices went up. Thanks, Lindsay. Yes, 58.5 cents per mile for 2022. I knew it was going to go up based on 2021 data. So you're going to get that back. So even if the prices for gas start to slide all this year, you still get to deduct 58.5 cents per mile for this year. And that mileage rate is supposed to encompass all costs of operating a vehicle in your business. It's calculated by the Government Accounting Office and is supposed to cover the operations of a mid-sized sedan for gas, insurance, wear and tear, repairs and maintenance, and decline in value over time. And how they come up with those, your guess is as good as mine. I know they have to crunch a lot of data to figure it out. So if you're going to take the standard mileage deduction, then you are not going to deduct any of the actual vehicle costs. Meals and entertainment. And you can see how I have scratched out and entertainment. Under the Tax Cuts and Jobs Act, which was the large tax reform that came out in 2018 when Trump was still president, they eliminated the deductibility of entertainment. And entertainment was defined as things like arts and performing arts, sporting events, concerts, movies, theaters, those different types of things. So if you go to a concert or a sporting event with a client, that is considered entertainment, and those costs, the cost of that ticket, is no longer deductible as a business expense. Now, if you buy food, the meals are okay. However, they clarified the rules further so that the meals must involve your business and it must be directly related to a business purpose. They have also reiterated the fact that you must document these thoroughly, and you're going to be limited to 50% of that expense. So we've advised our clients, if you're going to go out with a potential customer or a coworker or an associate, you're going to go talk business, make sure you order some food. Because if you just decide to sit around and have drinks, then technically the IRS has said that those expenses wouldn't count. There has to be food involved, and it has to be a business purpose. We tell our clients, just keep those restaurant receipts, jot a note on the back, who the meeting was with and what the business purpose was. If later down the road you got audited, the IRS would want to be able to see those different receipts to solidify the business purpose on that particular expense. If you are self-employed and you work out of your house, you are entitled to a home office deduction. Now, the rules are clear. You must have a space of your home that you regularly use exclusively for your business. It has to be the principal place of your business, and you must be able to show that. So normally what we're talking about is you have a separate room in your house, like a 10 by 10 or 12 by 12 room where you've got your desk and you've got everything set up. Now you're going to want to make sure that that is solely used for business. Don't store toys in there, don't have a bed in there, and unfortunately, a corner area over in your living room or kitchen is not going to count. It has to be an exclusive use, secluded area to qualify for that. The old regular method was a percentage method. You would take the square footage of your home office, divide it by the total square footage of your home, you would come up with a ratio. Once you had that percentage, then you would take it against your mortgage interest, real estate taxes, all your different utilities, your insurance. And then once you got that number, you could deduct that as a home office deduction. Well, about 10 years ago, they came out with a simplified method. You get $5 per square foot for your home office with a maximum deduction of $1,500. And there's no documentation required. If you got audited, all you would have to do is to make the home office available for inspection by the IRS agent. And obviously they would want to measure it to prove that the square footage that you used was accurate. If you go and use that old method that we were discussing here, you're going to have to keep all the utility bills, copy of the insurance bill, tax bills, and you're going to have to show all the calculations and how you did that. 90% of the time with our clients, we've learned that the simplified method is normally not easier, but also the larger deduction when it comes right down to it. Now we're going to change gears and talk about depreciation. Depreciation, by definition, is a reduction in the value of an asset with the passage of time, due in particular to wear and tear. Well, let me simplify that. You buy a computer in business. That's a great computer the day you buy it. You fire it up, works well. After about 2 or 3 years, it ain't working so good anymore. Slower, memory slower, gobbed up with possibly malware and things like that, but it's just going to be inefficient. Well, that asset has worn out over time. And so the IRS allows you to write off that cost over a period of time, and it's called depreciation. And you're allowed an income tax deduction to recover the cost of that large piece of equipment. Traditionally, depreciation applies to any kind of property that you know, that you own, that's used in business or held to produce income, has a determinable useful life, and lasts more than 1 year. So you buy a computer, it should last more than 1 year. You buy a forklift, it's going to last more than 1 year. All those different, even a desk, furniture, those are things that are considered assets that are subject to the rules under depreciation. Now, since 1986, this is the traditional system that we've used for depreciation. It's called MacRS. That stands for Modified Accelerated Cost Recovery System. And the useful life tells us how many years you depreciate that asset. 3 normally applies to things like computers, 5 is for equipment, 7 is furniture, 10 and 15 could be improvements that are made to a piece of equipment or to a building. And then we have down here if you have property, meaning real estate, 27.5 years for residential, such as homes and apartment buildings, Or if it's a warehouse or an office building, you would depreciate it over 39 years. One of the questions we get is, what about when I go and I take a piece of equipment and I fix it? Well, that falls under code section 263A. And we ask the question, well, was it a repair and maintenance, or is it a cost that we have to capitalize and subject to depreciation? So are you fixing the asset so it's just going to work again, or are you extending its useful life? If you're just fixing it to get it back into a working condition the way it was, then that's a repair, that's a maintenance. You're going to deduct that expense 100%. But if it's something like you've got a heavy piece of equipment and all you do is you go in and you do an overhaul and a tune-up and you can get another 10 years out of it, well, then that cost probably needs to be capitalized and depreciated over time. Now, the IRS has given us a lot of leeway when it comes to depreciation over the last 10 years. One of those is called the de minimis safe harbor election. We've got the regulation there. If you get bored, you're welcome to look it up and read it. So, but that safe harbor election stated that if you have an invoice item, a piece of equipment, for instance, that was $2,500 or less, you do not have to depreciate it. So you can literally write it off. So you buy a new computer, don't worry about depreciating it over time. You can follow the safe harbor. If you file the safe harbor election with your return, you could write off that $700 computer 100% in the year you bought it. Question is, would real estate purchased for the business be considered depreciable? Yes. Now it depends on what type of real estate it is. If you buy land, earth, soil, land, it's never depreciable. Land is never subject to depreciation. However, any buildings or structures that's built on that land or sitting on the land you bought is depreciable. As long as you're using that building or using that structure in your trade or business, then yes, it is depreciable. If it's for commercial purposes, such as an office, you're going to depreciate the cost of that structure over 39 years. If it's, for instance, a house or an apartment building, like a rental property, you're going to depreciate that over 27.5 years. There's a section of the code called 179 that gives us a 100% deduction. Now, as long as your business is profitable, you can deduct the 100% of the cost of that item placed in service, subject to some limits. And yes, Nicole, you buy a $2,000 camera, you can deduct it all in 1 year under either a multitude of ways. Number one, if you do the safe harbor election, yes, it's under $2,500. You can file the safe harbor election. You can expense that camera $2,000 the year you bought it. You can also deduct it under section 179, which is another way to write off assets 100% the year you purchase. There's also a code section called 168K that says you can write off 100% of the items you buy under the bonus depreciation rules. Now, the difference between 179 and 168 is that you don't have to be profitable in order to write off these items under the bonus depreciation rules. Whereas under section 179, you have to have a net profit. You can't have more section 179 depreciation deduction than you do profit. But the IRS has really changed the game when it comes to depreciation, especially for small business owners. Almost any time now, any kind of asset you buy, you're going to be able to write it off 100% under one of the various rules, whether it's the safe harbor election, whether it's section 179 or section 168K. The IRS has gotten very small business friendly. It's like they're telling you they want you to deduct these items because they want you to treat your business solely under the cash method. You buy it, you deduct it. Now, one of the things I wanted to throw in that is, got a question real quick. Interest payments on an SBA 504 plan used to purchase an owner-occupied property with 51% dedicated to the business deductible. Absolutely. anytime you're using loan funds to buy a business asset and you're using that asset in business, then yes, the interest on that loan would be deductible against your business income. Another question: started an LLC in 2021, purchased education courses to help with the business before you started to profit. Should you file or should you wait? Any individual is going to be considered a cash basis taxpayer. So you have business expenses. Those educational courses are deductible if they were helped to hone your skills in the business that you tried to start. Now, if those education courses gave you a different stream of income or qualified you for a different job, then you get into some murky area. But normally, if it's just some sort of education course, then yes, it's deductible. And it's deductible in the year you paid for it or put it on a charge card. So yeah, I would go ahead, if you've got some educational expenses and you started a new business and your intent was to start a business to be profitable, then yeah, you could go ahead and file, deduct those expenses on that Schedule C and get the benefit of them. You do not have to be profitable in order to deduct business expenses. There are some special rules that may be applied if you continue to show losses in your business, and those are called the hobby loss rules, and we won't get into those today, but you can always go and try to look those up. But if you started a business, just because in the first year you had more expenses than you had income, it's actually pretty common in this country to have a lot of startup expenses for a new business. So I say go ahead and take what you're entitled to under the revenue code, deduct the expenses, and don't wait. So I wanted to talk a little bit about the employee retention credit. This was new last year and became a really big thing. It came out at the end of 2020, right in the first quarter of 2021. So the employee retention credit was a refundable tax credit against employment taxes, and it was equal to 50% of the qualified wages that the employer paid to their employees after March 12th of 2020 and before October 1st of 2021. March 12th, 2020 was sort of the government's, what they considered to be the starting date of the pandemic. If you think back to 2020, I remember those days and that week, that was a very eerie kind of weekend. That was, that first weekend there, St. Patrick's Day was that weekend. I remember going home on Friday, and watching the news, and that's when really we started to get a lot of the news coverage about the spread of the COVID virus and how it was starting to affect things and how states were starting to shut down and how the economy was going to be affected. So the federal government kind of adopted March 12th at the start of the pandemic in their mind. And so most of the pandemic related provisions and assistance revolve around that start date of March 12th, 2020. So in order to be eligible for the employee retention credit, you had to have full or partial suspension of your operations because of a government order or due to COVID-19. The other way to be eligible is you had a significant decline in gross receipts. Now, for a full or partial suspension, one of the best examples is a restaurant. A lot of restaurants, especially here in central Indiana, were literally shut down during the pandemic. But if somehow the restaurant still had the cash flow in order to pay employees, and they chose to do that, then they would be eligible for the employee retention credit, regardless of what happened in their gross receipts, because they continued to pay someone during a suspension of operations because of a government order. Most of our clients qualify under the significant decline in gross receipts. Now, what does that mean? You had to have a decline of 50% in your 2020 gross receipts when you compared them to the same quarter of 2019. So what the government wanted you to do was to go and look and say, hey, let's say third quarter of 2020, you were impacted. So your business took a nosedive. Things were shut down. Customers didn't come in. Business was nowhere to find. So you look at your gross receipts for that quarter. Let's say in Q3 of 2020, your gross receipts were 25,000. Well, when you look back at 2019, your gross receipts were 50. Well, you had a 50% decline in quarter three. So now all of a sudden you qualify under the significant decline in gross receipts eligibility. So if you paid employees during Q3, quarter three of 2020, then you can go and get 50% of what you paid to those employees refunded back to you as a tax credit. Got a little question here that says, solely live on some disability income, took out a business loan, used it for startup expenses. However, business opened a week ago. What form of taxes do I file? If you're a sole proprietor and you're an individual, you haven't formed any sort of corporation, if you haven't formed a partnership, then you would just file your business operations on a Schedule C, which is just an additional tax form that gets attached to your Form 1040, your individual tax return. And you would record all the startup expenses. There are some special rules when it comes to startup expenses, but you can deduct up to $5,000 in startup expenses. The rest have to be amortized or deducted over time. But if you took out a small loan and had startup expenses, you put them on a Schedule C as startup expenses and you can deduct them there. So going back to the employee retention credit, what were qualified wages? For the purposes of this course, I addressed and made an assumption that all the participants today are going to employ less than 100 full-time equivalent employees during 2019. So if you had under 100 full-time employees in 2019, then what counts are the wages you actually paid your employees, and if you ponied up for some of their healthcare costs. For instance, if you covered 50% or 75% of their health insurance or dental or vision or other benefits, then those costs can be used to calculate. You can calculate the employee retention credit if you had that decline in receipts and you paid those people. And you paid them during that suspended period or the period of declining gross receipts. And now let me clarify, if you had a decline in receipts in quarter three of 2020, you can't use the quarter two wages. You can only use the wages that were paid during quarter three. Follow-up question, how long can you be in startup? Well, there is no real code section that addresses how long startup would be for a particular business. Me personally, I think a startup, it could be as long as a full year, 12 months. But there's no defined period of time, by the IRS when it comes to that. Now, there are some limitations on employee retention credit. If you went out and you had employees and you got a PPP loan, and if you recall, there were two different rounds of PPP loans. PPP stands for the Paycheck Protection Program. If you went out and got a PPP loan, you used it to pay your employees, and then you subsequently applied for and got that loan forgiven, meaning you didn't have to pay it back, then the wages that you used in your calculation to get that loan forgiven cannot be used for the calculation of the employee retention credit. You can't double dip. So you have to make sure that you differentiate which wages were used for the PPP loan forgiveness and which ones were used or you want to use for the calculation of the employee retention credit. There's also a couple of other code sections out there that may limit your employee retention credit. Under the Families First Coronavirus Response Act, you were able to get some credits if you paid employees for sick or family leave. And if you use those wages to get some credits under that act, then you can't use those wages for the employee retention credit. Same thing for the work opportunity tax credit. If you applied for and received work opportunity tax credits on some wages, you cannot use those for employee retention as well. Now, claiming the credit. Since we're beyond October 1, 2021, and if you haven't, there were some ways you could calculate the credits as you were filing your taxes during 2021 and 2020. But if you're beyond that and you haven't looked at this, and you're going to go back and look to see if you qualify, the only way to get those credits is to go back and amend your payroll tax returns for those quarters that are affected. You use Form 941X, which is the amendment form for 941. 941 is just your employer's quarterly income tax return. That's where you're reporting how much you withheld on wages, Social Security, Medicare, those different types of payroll taxes. If you go back and do the 941X, I will tell you, expect long wait times for the refunds. The IRS is in a world of hurt right now with going back and filing amended returns. They were shut down for 8 months because of the first round of the pandemic in 2020. They came back to work and had over 2 million unopened pieces of mail that they're still trying to get through, while they're also trying to catch up on all the paperwork they did for 2021. Let's get into some business tax planning strategies for this year. 4 different areas I want to address in this section. We're going to talk about entity selection, maximizing deductions, use of retirement plans to reduce income taxes, and whether or not you need to make estimated tax payments. Under entity selection, talked a little bit about this at the front end, but self-employment taxes are going to apply to sole proprietors, partners in partnerships, LLCs that are treated as partnerships for sole proprietors. You're going to be subject to some of those self-employment taxes. However, if you decide you want to set up a C corporation, you want to set up a corporation and elect to have it treated like an S corporation for tax purposes, or an LLC to have it taxed as an S corporation, there are no self-employment taxes on the income that passes through to you. And there's no self-employment taxes at the C corporation level. You only have to pay income taxes on the pass-through income. What's the difference between a C and an S corporation? A C corporation is a standalone entity that files its own tax return. It's called a Form 1120. For instance, IBM is a C corporation. You calculate your income, you calculate your deductions, you calculate the net income, and then you're paying, the corporation itself is actually paying the taxes. And right now, corporate tax rates are a flat 21% on C corporations. Now, if you own a C corporation, the only way for you to get money out of that C corporation is either through wages as an employee of the C corporation or dividends as the stockholder of the C corporation. An S corporation is a little different. You calculate income, deductions, and the taxable income on a separate tax return called an 1120S, 1120S, but the net income that's calculated actually ends up getting reported on your individual tax return as the owner or shareholder of the S corporation. And then you take money out of the S corporation in the form of distributions, which is the profit, or you also pay yourself as an employee of that S corporation. So then that income from, since the S corporation doesn't pay any taxes, it's considered a pass-through entity. It's going to pass through that income down to you as the shareholder and pay the taxes there. An LLC by default is not an S corporation. An LLC with taxes flowing through to your Social Security number, that means that you have formed an LLC, you didn't get a separate employer identification number, and for tax purposes, you're just treated as a sole proprietor. So you're going to fill out your taxes on a Schedule C. Now, if you have an LLC, you can file some paperwork with the Internal Revenue Service, and you can ask to be treated like an S corporation for tax purposes. But a lot of extra record keeping, a lot of extra expenses, a lot of extra tax returns. And yes, absolutely, I do the same thing, Stephanie. If you go out and get an LLC, I always recommend you get an employer identification number, regardless of whether you're going to be an S corporation or file your taxes on your Schedule C. It's always good to get the employer identification number, because you don't want to throw your social security number out there, because you're going to have to give it to your customers and vendors, because they're going to want to send you 1099s at the end of the year, but you just don't want that social security number out there everywhere. Maximizing deductions. This is a big one. No, Don, an LLC does not need an employer identification number, but you can get one for security purposes. You can get one for banking. You can get one for payroll if you intend to hire people, or I would recommend doing it for security purposes, just so you're not handing out your social security number. Biggest benefit of an LLC becoming an S corporation is an ability to control the amount of taxes you pay in FICA and Medicare, those self-employment taxes. If you have an LLC and you're treated as a sole proprietor, you're going to pay a lot in FICA and Medicare taxes. But if you elect to be an S corporation, then only the wages you take as an employee are subject to FICA and Medicare. The net income of the company itself are not subject to those. So there is a way to save a little bit of money on FICA and Medicare by becoming an S corporation. However, like I said, there are a lot of additional costs, a lot of additional record keeping. There's an additional separate tax return that has to be done. So before you leap from an LLC to an S corporation, it has to make sense. You have to have generated enough revenue so that the tax savings outweigh the additional costs and burden of record keeping that you're going to undertake. Easiest way to minimize your taxes right now is maximizing those deductions. And that's going to be record keeping. Make sure you keep good records. Make sure you use software to track all your income and all your expenses. Make sure if you have a business checking account and you somehow end up buying a bunch of business expenses out of your personal checking account, reimburse yourself. Collect those receipts. Fill out like a quasi little expense report. Put it in your business tax records and write yourself a check out of the business account and make sure that those get into the business records for the deductions. And then always personal use versus business use. If you have personal assets that were laying around doing nothing, and then you started a business and then started using them in that business, you can be entitled to a deduction for the cost of those items. So make sure you collect that information for your preparer. Retirement, another big way to save money on taxes. As long as you're generating net income in your business, you can implement a 401k plan. You can implement a SEP IRA. You can implement a simple IRA. You can see here with a 401k plan, you can put up to $19,500 into that plan. Even as a sole proprietor, you can get what's called a self-employed 401k plan, and you can put this money away. It doesn't reduce the amount of your business income that's subject to self-employment taxes, but it is an income tax saver. Just like you work in a W-2 job and electing to put money into your 401k plan. SEP IRAs, 25% of your compensation or your net self-employed income, you can put away into that IRA and reduce income taxes. And simple IRAs are simple. You can put up to $13,500. There are some catch-ups that are available if you're over 50 for all those different retirement plans. Estimated taxes. Estimated taxes are a way of paying income taxes if you had income that wasn't subject to withholding. So if you're not a W-2 employee, you own your business and you're generating your own income and expenses, you should be paying estimated taxes if you're making money. Those are usually individuals that include sole proprietors, partners, and S corporation shareholders, because all those different types of entities pass the income through to your individual taxes, and that's where you're going to calculate and pay them. Now, there are three components of estimated taxes. You have your ordinary income taxes, which are everybody subject to, but you could have the self-employment taxes, which are Social Security and Medicare, 12.4 and 2.9%. And it doesn't take a math major to look there and see that if you're a self-employed individual, a sole proprietor, you could cough up anywhere between 30 and 45 cents of every dollar you make in taxes. That's why it's very important to maximize your deductions, keep good records, and try to minimize that tax burden. If you're going to pay estimated taxes, they're due quarterly. Although these are some very awkward quarters, they don't follow calendar quarters. The first quarter is over at the end of March, and you have 15 days to go ahead and pay that estimated tax payment on your first quarter. But the next quarter is due June 15th, so you're paying taxes on your income generated in April and May. Then you get to pay on September 15th, which covers another 3 months income for June, July, and August. And then the fourth quarter ends on December 31st, and the fourth quarter payment is due January 15th. Last section we're going to cover today are some individual tax planning strategies. 5 areas we want to take a look at: family and health, education, job, home and property, and retirement. So what about family and health? Well, economic impact payment number 3 was due this past year. I don't know if you remember, but it was up to about $6,000 per family of 4. So if you did not get economic impact payment number 3, make sure you tell your preparer, or make sure you notate that in the software, because there was a big credit that's available for you on your taxes. Also, what about the advanced child tax credit? If you recall, last year, starting in July, the IRS was going to issue payments up to $500 per month, per family, per child per family, as an advanced payment on that child tax credit. If you didn't get any payments in July through December from the IRS or from the federal government that were noted as your advanced child tax credit, then you're going to get some extra credits on your individual tax return, and you're going to want to make sure you notate that. Question from Michael: how will you know when you're ready to go from an LLC to a C Corp or an S Corp? It's a great question, Michael. There is no solid set way to know. There are some general rules of thumb. Once you start making about $75,000 to $100,000 net, and when I mean net, that's net taxable income. Take your gross receipts, deduct all your expenses, and then that net taxable income is $75,000 to $100,000. That's a pretty good rule of thumb that it's time to at least start to weigh the benefits and costs of whether you should be a C or an S corporation. I'll tell you, in my practice, I only do about 3 C corporation tax returns. Most of our clients are either partnerships and sole proprietors, or they go ahead and they take the next step and they go to an S corporation. And $75,000 to $100,000 in net taxable income is a good time to start looking at that and to see just exactly what's involved. The additional fees, the additional tax returns, record keeping. You're going to have to do payroll for yourself or any employees. So about then is when it's a good time to really start taking a look at it. How should owner's draw be taken into account for calculating net income? It's a good question. If you're a self-employed individual, you're a sole proprietor, it doesn't matter whether you take that money out of the business account and put it in your personal checking account or not. You're going to pay tax on that calculated net income. So in a sense, it doesn't really come into an account. You're not really looking at how much you took out. At the end of the quarter, you should be looking at how much your gross receipts were, what your total expenses were, what your net is. And you're going to calculate your taxes on that net. Because whether you take it out of that account or not, you're still going to be liable for the taxes come tax time. So I usually tell my clients, focus on the net, not how much money you actually took out. Under individual tax planning, we have some the dependent care credit, 20 to 35% of $3,000 or $6,000 if you have 2+ children. Now, both parents must have earned income to qualify for this credit. So that's daycare, before school, after school care, any kind of daycare costs, you should get a credit on those things. There's also an adoption credit. Right now it sits at about $13,570. That's inflation adjusted. So if you do go and you go through the process of adopting a child, keep some meticulous records on how much you're paying the attorneys and the agencies, because there are some very large credits available for that. HSAs, if you're paying for your own health insurance out of pocket, and you have what's called a high deductible plan, you can open up a health savings account. What happens is all the money you put into that health savings account is deductible against your ordinary income taxes. Max for a family plan is you can put $7,200 in that health savings account and deduct it on your taxes. When you take the money out, it's tax-free as long as you use it, as long as you're using it to reimburse yourself for medical expenses you've paid for, or paying directly to the prescription company, the doctors, the labs, all those different types of things. Now down there at the bottom, I've kind of defined just exactly what the out-of-pocket minimum is in order to qualify to put an HSA. Basically today, almost every plan out there under IRS rules is a high deductible health plan, and you should be able to do a health savings account. If you're paying for any health insurance out of your pocket and your maximums are over $3,000 for a family, a minimum for a family, you can go to your local bank and open one up and put money in. Little question. Have a full-time job, haven't paid yourself from the business, and you've netted about $8,000 a month and you keep it in the business account. Don't know when you're ready for the business to pay me. Unfortunately, it doesn't matter when you're ready for the business to pay you. At the end of the year, at December 31st, midnight, technically December 31st, your tax year ended. So you're going to have to look and see how much came in, how much went out. And whatever that net number is, that's how much you're going to have to pay taxes on. So like I said, it doesn't matter if you took it out. So go back, look, and if you think you're going to owe, then you're going to want to go ahead and take some money out and use that money to pay the taxes. As a sole proprietor, can you get an HSA if you're covered by your spouse's health plan? I don't believe so. Because you're covered under your spouse's plan, you would have to look at your spouse's plan. So if you're on hers, then that means you're on a family plan. So you'll have to look and see if her plan through her employer is a high deductible health plan. If her plan is considered a high deductible health plan, then she can open one for the family and you'd be able to do it. She may have an opportunity to participate through the employer to put money into an HSA. One of our last individual tax planning strategies here, educator expenses. If you're a teacher, you can deduct $250 on your taxes for supplies you buy. College expenses. If you have kids in college or you're going back to college yourself, there's the American Opportunity Credit, $2,500 per student. Lifetime Learning Credit, $2,000 per year. Follow-up question on the HSAs. How do you handle the funds from year to year? They roll over. It's your money. Once you put it into the HSA, you can take it out whenever you want to, as long as it's for a medical expense. If you take it out and it's not for a medical expense, you're going to have to pay taxes on it. But you get to the end of the year, you still have money in your HSA, you can leave it. It's yours. Nobody can take it away from you. It'll just roll over to the next year. Student loan interest, you can deduct up to $2,500 on your student loans. Qualified tuition programs, 529s are a great way to save on your state tax bill. In the state of Indiana, if you invest in an Indiana 529 plan, you can save 20% of however much you put away with a maximum of $1,000 per tax return. It has to be an Indiana 529 plan for Indiana residents, but you can get up to $1,000 tax credit. So if you put $5,000 into a 529, you're going to get 20% of that, or $1,000 credit on your state tax return. Follow-up, I submitted a certification course from eCornell. Would that qualify? I am not familiar with what eCornell is. If it's associated with Cornell University, I know Cornell University is in fact an accredited university. You may want to hop on their website and just make sure that the certification course you ordered would qualify. Most education systems are supposed to tell you whether or not it would qualify under the lifetime learning credit. But if you paid for college credits, then yes, it would qualify under the lifetime learning credit. Got a big red slash on job expenses here. So if you have a W-2 job and you have out-of-pocket expenses as a part of that job, unfortunately, you no longer can deduct any of those. That was a big change with the Tax Cuts and Jobs Act of 2018. You used to be able to deduct those subject to a 2% adjusted gross income floor, you could put them on those Schedule A. So auto mileage, meals and entertainment, cell phone, uniform costs are no longer deductible as an unreimbursed job expense. Home and property, don't forget, you get a pretty big standard deduction now with these tax law changes. But if your mortgage interest, your real estate taxes, personal property taxes, which are your auto B&V fees, your charitable contributions, those things add up to more than the standard deduction, you can still itemize. Right now on a joint return, the standard deduction is about $25,000. That's a pretty big standard deduction. So you'd have to have a lot of mortgage interest and charity and real estate taxes to get over that big hump there. And retirement, even individuals can put some money into retirement. If you're not covered under an employer plan, or you don't have one through your small business that you own, but you are an individual and you have some earned income, you can put some money away into a traditional IRA. You get to deduct it from your adjusted gross income, and the money is not taxable until it's distributed during your retirement years. Now, Roth IRAs are a little different. 6,000 is the limit. That's the same, but there are no taxable benefits right now. You put money in a Roth, you do not get to deduct it from your taxes. The good news is all that growth, all that earnings, all those market returns, when you start taking them out in retirement years, absolutely tax-free, all of it. Or think about doing a traditional to IRA conversion. If you have a traditional IRA and you like the how Roth IRAs work, and you think those might be a better fit for you, talk to your advisor. You can convert your traditional IRAs to a Roth. You basically have to record all that amount into your revenue now, and you have to pay taxes on it, but there's no penalties to convert it. And then now it's converted into a Roth. It's going to grow tax-free until you retire. Follow-up question, is there a rule of thumb based on income to knowing how much in estimated taxes to be paid? Here's the best rule of thumb. If you're a self-employed individual and you know you're subject to self-employment taxes, that's going to be about 15% on your net income each tax quarter. So that's your gross receipts minus your expenses, and you get that net. You know it's going to get subject to self-employment taxes, which is about 15%. Now you have to look at income taxes, and that's going to depend on how much money you make. If you're married and your spouse also has a job and makes money. But a good rule of thumb is about 15 to 20% in income taxes. So for federal tax purposes, you're talking about 30 to 35% for estimated tax payments. And don't forget the state of Indiana. You're self-employed and you have self-employment income. It's also subject to state and county taxes on that state tax return. That's going to be about 5% depending on what state you live or what county you live in. State tax rates in Indiana are 3.23%. Ohio participants, I apologize, I do not know what the Ohio tax rates are off top of my head. But in Indiana, we also have additional county taxes that are going to have to be paid. For instance, if you live in Marion County, I can tell you, you're going to pay 3.23% to the state, and you're going to pay 2.02% to Marion County. Now, it all gets calculated on the state return, but that's 5.25% on that additional income. So, rule of thumb, if you're self-employed and subject to self-employment taxes, you can look about 30 to 35% on federal and 5% on state. If I recall, Ohio rates are a little bit higher. I want to say 5 or 6% as well. Might be a couple of percentage points higher. But Ohio has some really good small business deductions that are available. So I have listed out some additional resources. If you ever want to look up and have a little bit of light reading, you can go and look at any of these different publications. I'll leave that screen up right now while I go ahead and take some questions. I believe, yeah, I'm through my stuff. I want to thank everybody for their time today. I know we ran over just a little bit, but I wanted to make sure we got through all the material. I wanted to make sure you took away some good ideas and some good thoughts on going on how you're going to calculate those taxes and how we're going to be able to do those things. If you want to get in touch with me, I'll make sure that I'm available. Here's my contact information. I'll make sure that SCORE sends it out to you if you want to. So let me go back a couple for the publication screen real quick, and I'll look at a couple of questions. 501c3 questions. Look at this. If you run an event for a sponsor and they provide compensation for expenses and materials only, how do we show that one? Merle, email me. Email me on that one. That one's a little bit too complex to try to read through and answer here. So take down, I'm going to go ahead and go to the end now, put my contact information back up. Hopefully everybody's got some publication 334, 463. Usually 334, 535 are probably some of the two best for small business owners. So just remember 334 and 535. And then here is my contact information. You're free to email me. It's just jason@craceandbeam.com. Yes, absolutely. If you paid for a workshop like anything like this, then absolutely it would be a business expense. I would stick it under professional services. You could stick it under continuing education. If you're filling out tax forms, it doesn't necessarily matter how you title it, as long as it is a legitimate business expense. And a course like this absolutely is. So there's my contact information. If there's any other questions, feel free. Email me anytime. Give me at least 24 to 48 hours this time of year to get back to you, but I'm happy to answer any follow-up questions for anyone. And at this point, if there's no more questions, I'm going to hand it back over to Mike, and let us go ahead and wrap this thing up for today.
Yeah, Jason, this was very informative. We thank you very much for your time, your insights, and your ability to quickly answer questions as they rolled to you on the chat screens. So with that, we thank you, and we thank our participants. The session has been recorded, and we'll make it available to the participants relatively soon. So thank you for your day, and or thank you for your time, and have a wonderful day. Okay.
Thanks, everyone. Be safe. Have a good tax season.